Hey traders, this is Blake Morrow with Trader Summit, and I have the pleasure of having both Mr. Michael Brown from TraderX and also Mr. Richard Matthews from Pardus FX joining us today to talk about all the mayhem that we're going to be dealing with over the next few days with the FOMC, the ECB, and non-farm payroll. Gentlemen, good to see you both.
Evening, Blake. Good to see you, mate. How you doing?
I'm doing great. You know, this is it's always whenever we meet, it's going to be a historic week, right? But this week might be rather interesting. We have a couple central banks, some big central banks that are meeting today, right? Or this week, excuse me.
Cool. Yeah, sure. I've got the FOMC and the ECB. I mean, is the ECB really a central bank or just a loose collective of finance ministers? I actually don't think it is a central bank technically. Anyway, don't get me on to Europe too early in the show, but it should be a good week.
It should be
plenty to chew over, plenty of volatility. Hopefully, market's going to suddenly wake up. We've had a quiet few weeks, as I'm sure we're all painfully aware of. So as you say, a busy data docket, and also you've got Apple earnings in the mix as well on Thursday. So plenty for traders to get their teeth into.
So let's start with the big elephant in the room with the Fed. And since no. Richard, I was not talking about you, but let's talk about the Fed really quick. You know, the Fed, from what it seems, they're going to raise rates 0.25%, and it looks like they might be on hold for a while. Is that the general consensus in your views from across the pond?
I think it's the consensus. I think that actually the consensus is they'll raise by a quarter and then they'll start cutting in the last quarter of the year, which I think is wrong. I think they'll raise by a quarter, pause, and then I think they'll raise again later in the summer. But I am on my own in that view. Rather than my what do you think?
I think most can probably tell from my facial expression there. I wasn't expecting him to say that. I think 25 basis point hike this week, that's pretty much nailed on. I think what's interesting, though, is I think it's unlikely that the Fed are going to do what the Bank of Canada did and what the Reserve Bank of Australia did and have then undone in terms of actually giving us explicit guidance that they are now pausing the hiking cycle. Because what the Fed don't want is any real significant loosening of financial conditions. And if their statement were to come out and Jay Powell was to come out tomorrow night and say, we're raising rates 25 basis points, and that's it. We're now on hold. We may hike again if the data warrants it, but we're now on pause. You're going to see equities tear higher, the dollar come sharply lower, and financial conditions loosen quite significantly, which would undo, a year to 18 months worth of work that they've done to try and tighten things up and get inflation under control. So I think actually the message from the Fed is probably not going to be too dissimilar to that which we heard last month, which is where they say 25 basis points, some further tightening may yet be appropriate, but actually perhaps a little bit of a softening of the guidance at the press conference, which just leads market participants to expect that this is it in terms of hikes. But I'm with you. I certainly don't expect any cuts this year, that's for sure.
Do you think inflation is under control, Blake? In the States?
But it probably depends on who you're going to ask and what part of the United States they're in. But I still think rents are pretty high, and that's one of the things that are, and energy costs are still really high, especially where I'm at. But that they're really going to keep inflation, I think, is going to be, it's relatively high for most Americans, and it's a big talking point as we go into this political season too. So. It's going to be interesting to see how the Fed does tailor that. I think, Mike, you bring up a great point that, they don't want to see equity markets rally. They don't want to see those financial conditions loosen, because you're right. It's just going to perpetuate the inflation issue. How big of a surprise was it to the two of you last night or yesterday with the Reserve Bank of Australia?
Well, it was a rude awakening, let's put it that way, at 5:30 this morning. I was sat there in bed, and all of a sudden Bloomberg starts going absolutely mental on my phone, talking about a 25 basis point hike. I said to someone at Reuters this morning, they rang me for a quote very similar to the question you just asked. And my first words were, actually, the RBA have made the Bank of England look competent here. They came into the year saying inflation and inflation expectations are a real worry. We get to March and all of a sudden they're not too much of a concern and they're on pause. And then we get to May and what do you know? They flip-flop to the other side and they're worried about it, even though both have actually come lower. So goodness only knows what's going on down there, to be quite honest with you.
I think they may have done the Fed a favour, actually, because everyone's got set in mind, central bank's going to tell us what they're going to do, they're going to be led, they're going to aim for this, aim for that, whatever. Whereas the RBA is just throwing out a complete curveball, and all of a sudden you don't know what they're going to do, you don't know what a central bank's going to do, which helps you keep market conditions tight. I actually think that they've done the Fed a favour. Inadvertently, I doubt it was deliberate.
Well, that's a good point of view, Richard. Now, let me ask you this: out of all, and we're going to get to the ECB here in a second. We're going to take a look at the euro dollar. But before I move on, make sure if you guys and gals you're watching this, make sure you give both Michael and Richard a big thumbs up. Jump it down in the comments below. Let us know what you think about the Reserve Bank of Australia. I'm sure that you have some comments that you'd like to spew out as well. And these gentlemen will get back to you in the comments below. But out of all the events this week, obviously we got some volatility with the RBA last night. But which event do you think this week is going to give us the most volatility from a trading perspective?
Go on, you can have that one first.
Well, I'm going to be really controversial here. I don't think you should look at non-farm payrolls. I just think it's a nonsense crapshoot every month. I actually don't think it's that important. I thought jobs today was quite interesting, was not such a good figure, but I'm not convinced that non-farm payrolls is as important as people think. So on that basis, funny enough, I think it could be the ECB. Actually, I think the Fed's pretty nailed on what they're going to do, 25 basis points higher for longer, blah, 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 blah. Non-farm payrolls, obviously, I turned my nose up at, so it's going to be the ECB.
I mean, I would counter that by saying
But the ECB's ever interesting.
I would also say we all know what the ECB are going to do as well.
Do you? Do you think?
25 and more to come, but we'll get on to that in a second, as Blake said. I'm tempted, and I know we've had a big move in the S&P, and we've had a big move in the FX space today, and of course a big rally in treasuries, especially at the front end of the curve. I'm tempted to think that today might actually be the most volatile day we see this week. Given that, I know I might tempt fate saying that, but we know what the Fed are going to do, and Chair Powell has been pretty good recently at sticking to that script and being and holding press conferences that are very composed and actually taking a lot of vol out of the market. The ECB, I think, again, we know what they're going to do, and we'll get onto that in a second. And then the payrolls number on Friday, as Dick rightly said, we've got those questions around the accuracy of the data. But we've also got to remember that, it's Friday afternoon. I think at that point, everyone's going to be so knackered from the week that we've had. They're just going to be looking to take risk off the table and get to the exits. So I think if you put a gun to my head, I'd say the Fed is probably the one that's going to cause the most cross-asset vol. But actually, in a sort of perverse sort of way, my expectations for decent, prolonged moves are a little bit low.
Well, I do want to get to the ECB, but let's talk jobs report really quick. And I want to ask you all this. The labor market has been extremely strong here in the United States. And when do you think, and when do you anticipate that we're actually going to start to see some cracks in the employment figures moving forward? I mean, it's kind of surprised everybody, most analysts, that the jobs market, I know it's a lagging indicator and it's going to be the last to go, but when would you both anticipate that we start to see some weakness in the U.S. labor market?
It's a good question. I think if you'd have asked me in January, I would have said by the end of the quarter, and I'm probably going to give you a similar answer now. It's quite astounding how the labor market continues to remain resilient despite the lagged effects of tightening and also the tightening of lending conditions after the various banking issues we've had and all the rest of it. I think all indications are that we're getting nearer to that point where the jobs market starts to roll over. As Dick said, obviously job openings coming down quite considerably in the month of March. Actually, if you look at jobs on a year-on-year basis, if you look at the percentage change, I think we fell by just over 20% year on year in terms of job openings. The only times we've had bigger falls than that are right when COVID started and during the financial crisis back in 2008. Now, I don't want to, start saying that history is going to repeat itself all over again, but I think that's a pretty reliable indicator. And of course, the other thing is when lending conditions tighten, a rise in unemployment generally follows. So I'd expect some point between the next sort of 3 to 6 months, we do see a decent rise in unemployment, and we do see payrolls growth cool off and probably even turn negative. But you've got to remember, this is actually what the Fed wants to see. At the March meeting, the Fed staff, according to the minutes, actually presented in their forecast that a mild recession in the second half of the year is their base case. And the Fed still raised rates by 25 basis points, and they're going to raise rates by another 25 basis points on Wednesday evening. So the Fed want to see the economy soften. They want to see growth slow. They want to see the labor market weaken, and they want demand to come off, because that's how you're going to get inflation under control.
I actually think somewhat differently, of course, surprise, surprise. I think the whole labour market changed on COVID. And I don't think you can compare the labour market now to what it was 3 years ago. And I don't think that you can measure jobs reports the way that we used to do. People are working from home, they're job sharing, they're moving around the country. You've got things like Uber don't actually really work for anyone anymore. So I just think the whole jobs market has changed. So it's a really, really hard number to read. And I agree with Michael that Fed is waiting to see something break. Now, whether it's the banking system in the States, which is probably being a little bit dramatic, or the jobs market, but I think they're comfortable until they see unemployment up at 4.25%?
Yeah, I think
it's a long way to go.
Yeah, I think, we're at 3.5 now. I think the year-end forecast is around 4.5. So as you say, there is a long way to go. And you've almost actually got to assume that if that is the Fed's year-end forecast, as they've said, and obviously we'll get another set of forecasts in June, unless we get a rise in unemployment above that, then is it really going to be of too much concern? Because officials can reasonably turn around and say the economy is evolving in line with our base case. This is what we expected to see.
Both great points from you both, actually. And so the non-farm payroll number, it's going to be really interesting.
It is.
It's going to be really interesting to watch. I have had a difficult time trading against the non-farm payroll numbers. I keep thinking they're going to outperform. Last month was the first month that I thought they were going to come in a little worse than expected, and they still showed up. And I think it's going to be really interesting to watch the evolution of the U.S. jobs market as we go into the remainder of the year. But let's shift gears over to the ECB, since that is one where you have a lot of expectations for the ECB that they're going to raise at least 25 basis points, maybe even come in with another 25 basis points or even more as the year goes on. And I know there's probably going to be a debate between the two of you regarding that. But the bottom line is the Fed's expected to raise and pause. And we're going to continue to see that divergence between the ECB and the Fed more than likely going into this after this week. So, if you're trading the euro, you've probably realized that euro is sitting so close to a breakout point, and the pullbacks have been very shallow. As a technical trader, I always know that when pullbacks are shallow, you got to be very careful, but because that means there's usually a resumption of trend. Even today, bids are coming in. People worried about the U.S. banking system. They're selling dollars, buying euros. You can see that euro not too far away from yearly highs. So let's start with you, Dick. How do you feel about the ECB, what they're going to do this week, and how's the euro going to perform in your view?
I think they'll do 25 because Europe always likes to compromise. They never like to really put their neck on the line. The hawks of Northern Europe will want 50. I think that there's just enough evidence of a slowdown in Germany to keep them under control. So I think you see 25 with a promise of another 25 to follow. On that basis, on an interest rate differential, you've got to buy the euro over the dollar. No, you've got to buy the euro, full stop. Hush my mouth for saying such dreadful things, but unfortunately, I do like the euro. Unfortunately, I do like the euro at the moment, purely on that basis.
Usually, I'd throw someone out of the office and say.
So, Michael, how do you feel about the ECB this week?
I agree with Dick. In all honesty, I think it's been pretty well telegraphed. We get 25, as he rightly said. You know, you're going to have that compromise between the hawks who might be pushing for 50 and the doves who would want a smaller move or perhaps even no move. Although actually on that note, it's interesting that pretty much every ECB speaker we've heard of lately has been indicating that they are in favour of a rate hike. Even Philip Lane, the chief economist, who is known as one of the most dovish members on the governing council. The data we had today, the bank lending survey, was a little bit worse than expected, with credit conditions tightening quite significantly in the first quarter. Yes, it's lagging a bit. And of course, the latest inflation numbers. It amused me earlier. There was some journalists sort of jumping for joy, predictably on CNBC. They were talking about how Eurozone core inflation has peaked because it's come down to 5.6 from 5.7%. But of course, this is the third time now we've had Eurozone core inflation come lower compared to the previous month. And the prior two times, it carried on going higher. So I think anyone betting on a peak is probably misplaced at this point. And until we see two things for me, one, a definite peak in core inflation, and two, a significant cooling in earnings growth in the Eurozone, the ECB are going to keep hiking. That probably means they're raising rates well into the summer. And as you rightly say, you know, rate differentials, the Fed on hold, the ECB are going to be the last hawk in town, I would expect. You've got to expect euro dollar to go higher, and you've helpfully got rid of your chart. But I think 110.75 was the high that we saw a little bit earlier in the year. If we get above that level, then euro dollar really could start to run.
All right. Well, you know, that's great views about the euro and the ECB. I'm gonna hold your feet to the fire a little bit regarding a couple of things that I know that might be on the radar for you. You know, and I know, Dick, you don't necessarily focus on the BOJ, but the BOJ really, you know, Ueda's first meeting, he came out Kuroda style and weakened the yen. Are we going to see continued weakness, Mr. Brown? Are we going to see continued weakness in the yen and see the dollar yen gun for the 140 yen level? What do you know think?
What? It's an interesting one. This I was talking about this with your mate Ryan Littlestone earlier on this morning, actually, in this very room, and we were talking about the Bank of Japan, and we were both saying that the market's probably gone and latched onto the wrong thing here. I think everyone was trading the yen from the short side on the back of the policy review that they announced, taking up to 18 months, which was a lot longer than the timeline market participants had envisaged for policy being shifted. I mean, that pushes you out to the early part of 2025 if you're not careful. But I think actually, if you dig into the BOJ statement, they upgraded the growth forecast, they upgraded the inflation forecast, and they also ditched the easing bias that's been in place since before the pandemic, and probably since the beginning of time, actually, knowing the Bank of Japan. So I think actually the move in the yen is probably one to fade. The problem with that is it does seem very much one-way traffic at the moment. So I think if dollar yen gets up towards that sort of 138 mark, then I may be looking to play that from the short side, from the long yen side, of course. But actually, for now, I think you've got to let that momentum run, let the market burn itself off, maybe get the Fed out of the way first, and then we might see some logic take over a little bit.
Do you think there's any chance that the BOJ is going to change their attitude and they're going to surprise the markets completely out of the blue?
Yes.
And just do something completely out of the blue. One day you'll wake up and say, my God, I can't believe they've done that. And not on a set BOJ day.
If any central bank will do it, the BOJ will.
Yeah. So that
or the Swiss National Bank, because they've done
Swiss National Bank. And that's the one thing I'd be wary of, and I'd be with you. I'd like to be long yen. The old Bill and Ben.
Yeah.
long of yen. All right. Well, Mr. Matthews, it's to you. Let's talk Bank of England really quick. How are these gentlemen over there at the BOE going to keep up with the ECB and the FOMC this week? What are your thoughts about the Bank of England?
Unprintable. I'm not saying them. Not when we've got a new king being crowned this weekend. The king of England and all places which are good. God only knows what they're going to do. Inflation's out of control here. I've said it so many times. Inflation's out of control here. They haven't got a clue what they're doing. At least Henry Rowe has gone or is going.
Thank God for that.
Who thought interest rates should drop? They should really put interest rates up by 2%, but they won't. They might do a quarter.
Yeah, no, I think you're right. They'll do 25. I mean, I haven't been on since this happened, so it gives me a chance to rant. But I think it sums it up when you've got the chief economist at the bank coming out and saying you all need to accept being poorer. I mean, the bloke may as well just come out and say, I don't want to do this job anymore. I mean, that's career suicide. But yeah, I think, as you say, we've had, 7 months now of inflation above 10%. Energy prices will come lower from April because of the way the price cap works over here. So the BOE will do a little bit of a victory lap, and Rishi Sunak probably will as well on the back of that. But we do have a real problem with inflation here, and it's actually a problem with stagflation, I would argue. The PMIs that we're getting are not great. We've got GDP in a couple of weeks. That for the first quarter, that's probably not going to be too brilliant either. And the BOE are going to raise rates. You're going to see gilts move higher. The curve will shift higher, but would you want to buy a currency that's in a stagflation environment? I certainly wouldn't. I don't like the pound at all at the moment.
And the official CPI number is miles wrong. I mean, inflation is probably 15% now. I've said it week after week after week. Food inflation is just unreal. Porridge is just so expensive. I can't have my daily porridge. I can't afford it anymore.
Well, stagflation is definitely not a word that I wanted to hear from either one of you, and it's probably something that it might be plaguing the UK, and it might make its way here in the United States to the other side of the pond as well. Maybe like a secondary pandemic, if you will. But gentlemen, I got to say, it's fun having the two of you, always entertaining, but more importantly, very informative. And if you all really enjoyed having Mr. Brown and Mr. Matthews both here from Pardus FX and Trader X, make sure you give them big thumbs up. Gentlemen, I want to thank you for spending your time with us. Good luck this week, and thank you for all the great ideas and analysis of the markets.
Fantastic. Good to speak to you.
Good to chat, Blake. Thanks for having us, mate.
Cheers.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.